That means 9:30's opening price will be regular trading hours opening range gap low. Okay. If if you play that part over a couple different times and write it out as I said it, it's perfectly understood and you'll be able to see it by going back through your data and annotating your chart that way. Okay. So we have at 9:30, the market opens up and it's attacking buy side liquidity, which are these relative equal highs. And then we have that change in the state of delivery on the 15-minute time frame. That's this pink line right here. It trades up into that. You see that? So what are we doing here? We're getting a higher time frame premise. I'm giving you an entire complete trading model today, in case you haven't noticed that. We're going from a daily chart and we're trying to get a feel for where it's likely to draw to. Where is it likely to draw to? Not just for today, but on a longer scale price run. What is it likely to go to? Where's it drawing to? Don't be afraid of being wrong on that daily chart. There's going to be lots of daily candles that go against this idea. And traders that are brand new or students that are brand new to this idea, they get their, you know, emotions all whacked out because they have a day that just screams against that and they think, oh no, I better change my bias. I better change the way I'm looking at this. I'm probably wrong. And by constantly referring back to the daily chart, it'll keep you in focus so that way you're not going back and forth intraday, buying and selling, and second guessing your higher time frame premise. Okay, so my bias is bearish on NASDAQ. My premise is it's likely to start seeking lower prices now because we have an inside day on the body basis. Today's body of the daily candle is inside of Friday's range. So I'm expecting tomorrow or Wednesday's volatility to start showing one-sidedness and big down black closed candles. That's what I'm looking for my chart. Now, whether or not that happens, remains to be seen. But that's what I teach my kids. That's what I've been doing for 34 years. I'm trying to promote that idea as a student to study price action with that view in mind. Okay. So changing the state of delivery, we watch and see because it could go up into that gray box. Why? Because Monday's regular trading hours opening range gap is last Friday's 4:14 p.m. Eastern Standard Time regular trading hours closing price. That's what that price is up there at 25,079 even. That gray box is new week opening gap. So there's two things that could lead to this gravitating towards that going up there. Okay. So now the question is you watched Cameron trade, and now I'm going to explain what I would have done if I were doing the actual trading and not sitting with him and it was just me isolated solo, just doing my normal thing. I would do this. The buy side's here, it runs above that. As soon as we hit the change in the state of delivery, I'm looking at this up close price. That's rejection block. I'm going to wait for that to trade below it like we do here. And as soon as we get that here, I'm hitting that, and my stop loss is going to be mid new week opening gap. One contract, one, not six like you see me do on my standard run, just one contract. And then I would look to build another entry in it. Here we have 9:30 opening. So that's the opening price at 9:30, which also is, in this case, Monday's regular trading hours opening range gap low because 9:30's opening price is lower than that last Friday, 4:14 p.m. Eastern times closing price on regular trading hours. That means you're going to have to toggle that chart, which is not showing that now. It's electronic trading hours here. So you would toggle it to regular trading hours. We've done that so far in this live stream. So we don't need to do that now. The charts have been annotated. So all these levels here is what's on my notepad. You're all asking for what's on your notepad. Show us your notepad. This is what I'm putting on here. There's nothing secret on here. I promise you. Nothing except for this stuff. So once we started to drop off, it could still run that high. And as we're seeing it run up here, watch what happens. This high here with ES. So we go with EMES H2026. What do you see different here? NASDAQ had a lower high. See that? ES was pushing higher. It was pumping it higher, higher, higher. So this is SMT. So for your notes, when is there a high probability for efficiency using SMT related correlated asset analysis? In other words, you're looking at ES versus NASDAQ. When is that appropriate? When am I even considering it? When there is a liquidity run or a high volatility injection like news. Okay. 9:30 is always going to act like that. 9:30 is running liquidity. The first few minutes, first 30 minutes, we're looking for liquidity for it to gravitate towards. In this case, we're seeing that Judas swing higher at 9:30. Here's 9:30's candle. It rallies up and it makes a high, higher high, higher high. Bull flag traders are going to look at that and fall in love. That's my Valentine. Kissy, kissy. But this is the kiss of death because we're going to go back to the NASDAQ and see how it made a lower high here. So now, when do I use stop orders to get into a trade? Or when do I mark it in when I'm watching price action trade to and through a specific level? In this case, Cameron was prompted to watch that candlestick's opening price right there. When price was rallying up like that, I told him, I said, as soon as you see it trade through that opening price, as soon as you see it, enter at the market, sell your 2 contracts of micro. He put his little clicker on. You've seen him click on it, okay? And just so you know, notice how I keep my chart centered. I'm very, very OCD about it, okay? And it was driving me nuts, but I couldn't tell him to fix his chart, and I didn't want to touch the mouse. But as soon as he put the order in, I said, "Now it's going to drop a little bit. Give it a chance to drop, and then you're going to put your stop loss just below the opening price because if it's going to run, it's going to rip through it real quick." And you can see him, he's hovering over top of the close button. He's indecisive. He don't know what he's wanting to do. And he's like, okay, when do I do it now, dad, dad, dad? Because he's used to fair value gaps. So now what I'm teaching him is sharp reversal patterns. And this is what we're covering today. Okay, so the topic today is sharp reversal patterns and using stop orders or market orders, not limit orders. So when am I doing that? Here we're seeing an SMT divergence. We have the change in state of delivery traded to on the NASDAQ. This high here, I'm going to see it fail. I don't need to get up here and short it. I don't need to do that. But I would have already been short on this candlestick right there with a stop loss at mid new week opening gap. If I would have got stopped out, no problem. I would have been waiting for another setup to see it break down and look for some kind of a fair value gap, some kind of institutional order flow entry drill, something that affect a bearish breaker. I would have looked for it to then also present a SMT divergence up here. If you're looking for SMT and it's not occurring, or if you're not looking at it at a time when liquidity is being taken, with the express interest of it likely going another direction, opposite direction. Or if you're not using it at the opening range, the first 30 minutes, you're probably looking for SMT in the most inopportune times. SMT is wonderful, folks. It's a wonderful idea and concept, but there's a place for it, and it's not in every setup. So if you want to use SMT, smart money tool, smart money technique, okay, I never really settled on what the T stands for. It's just the divergence between closely correlated pairs or assets. So if it's Forex, the same thing there. It's liquidity or opening ranges. Here, as it dropped down through it, you can watch the recording I posted on X where he put his little sell order in for his 2 micro contracts because his account has not had the withdrawal taken because he had to send them a bank statement. So you have to send the bank statement in, wait for them to approve it, and then you do the bank wire. And the process of doing that today, he said, let's just see if we can add a little bit more to it. And that's what he did today. So there you go. So now he's just underneath 13,000. So it's yeah, just like a couple dollars below 13,000. So basically almost 30% return in 2 weeks of trading, micros, and 3 grand. So that's real money. Now, what does that mean for you? Nothing. Should it inspire you? No, because anybody's trading shouldn't be used to inspire you. The conceptual ideas I'm teaching here, that's what you should be inspired by because this is the stuff he's learning how to do. And he's doing it with a real account, not demo. Told you, real money this year. We're not trying to, you know, pull your leg anymore. We're not trying to keep you in demo mindset. Just focus on starting very, very humbly and going forward and just using concepts with low leverage, and you'll be able to hold on to the setups. And he's learning right in front of you. So you're getting like a test tube environment watching my actual son. So it breaks below that price, and look at the excitement lower. Boom, lots of animation. And where did it run quickly for? Those stops right here. That's exactly what you want to see. You want to see that. Now, when that occurs, do we want to see this entire gap here fill in and do any kind of patchwork over that? No. We want to see a small portion of that left open. So I'm not sure if I got that. Yeah, there we go. So this gap here, there's consequent encroachment of it. And we can grade that also. Now watch, this is the purpose of having all those levels on your Fibonacci. Okay, this is gonna be worth the price of the admission today. The bodies, notice that they cannot even get back to consequent encroachment, which is the midpoint, 0.5 level. The wicks are allowed to do the damage, but it went through consequent encroachment. It went through the 0.625 level, but it could not get to the upper quadrant 0.75 level. You see that? Failed to get there. But then reversed and the bodies were below mid-level consequent encroachment. That right there indicates weakness. It doesn't mean get short with an ultra short little tiny stop loss because the volatility right now is exorbitant. It means expect it to eventually work its way lower. Here we have another attempt to get up into it, but now look what this does. It doesn't even get to consequent encroachment at all. Now we have a lower high in deference to this high inside of this inefficiency. No bodies of the candles are allowed to be laid down in the upper half. That's real institutional order flow. You don't need level 2 data. You don't need level 3 data. You don't need whatever else you want to call that stuff out there. Nothing. You don't need any of that stuff. Footprint, none of that. You don't need it. Volume profile, you don't need none of that. Okay? I promise you, it's as simple as open, high, low, and close in time. That's all you need. And that's not complicated. None of the things I'm showing here is a new twist on anything. I'm just giving you a refresher. And what I was kind of like pressing on my son this morning, to focus on this, focus on this. So this drop down here, notice these relative equal lows here. I told him be mindful of that. It's up to him if he wants to close his trade below this or hold for these relative equal lows, which is what you've seen in this chart annotated. So these relative equal lows is sell side, and then you have these as well. So as price dropped down here, his excitement was like, I don't want to give it up. I have a good win. And that's okay. You're managing the trade. You'll learn either way. If it goes down and hits the lower sell side, you'll have an experience. If it doesn't and you lower your stop and it stops you out, you'll have experience doing that too. But whatever you feel inclined to do, just do it. Don't think about it. As soon as you feel it, do it. Because that's the only way you're going to get a baseline on evaluating what your emotional and psychological impact of your actions are. You can't hide from them. You have to be honest in your journal, and you can't lie to me because I'm watching you do it. So you saw what he did. He lowered his stop down, and it came back and stopped him out, but then ultimately went down to the lower relative equal lows, which are these over here. Okay. So obviously, when that happens and you're new and you're thinking, well, I could have made $400, Dad, and or if you're saying it to yourself, I could have made $400 and I only made $304. So I wish I would have stayed in there and made the extra 115 or $111 more. I wish I would have done that. Don't do those things. Don't dwell on that stuff. Look at what you did right, and then where are the opportunities that you could have done things differently. You're not armchair quarterbacking yourself and beating yourself up and saying, this is what you did wrong. Highlight what you did right, congratulate yourself, encourage yourself that you did this and it feels good to have done that. And then saying, now, these are things I could have done, but I didn't notice it at the time, and or I don't have the experience yet to navigate it like that. But this is a wonderful experiment for me to now use for experience to move forward in my next opportunity using this information. You see how that completely disarms you? It doesn't give you any reason to feel emotional about it. You're not priding yourself and building yourself up with ego, but you're also not tearing yourself down for not having done it perfectly. And that's how you use a journal effectively. I watched that guy who supposedly is an ICT student. He says he gets out there, and I think it was last week or sometime, in the post. I'm paraphrasing now, mind you. I think the stupidest thing I wasted time on was journaling. It doesn't do anything for you. Don't do it. Okay. I promise you, this person's going to want to go right back to that because what that is, that's King Kong feeling because he's finding a little bit of consistency right now, and he's thinking, well, I wasted all that time, not realizing what he did got into the position he's at right now. Like, how can you say I wasted all that time, but you're doing okay now, and you're going to tell other people not to do it? Don't listen to people that say that stuff. I promise you, don't do that. Because if you're not keeping record of your development, if you're not logging that, if you're not measuring that, how do you know if you're really getting better? Or if you're just feeling a high when you're doing it good and when you do it wrong, you're beating yourself up. But if you have journal entries showcasing what you're actually doing and how you're perceiving price over a long set of time, that's the only way you're going to get a baseline for evaluating whether or not you're progressing or not. It's not the outcome of the trades, folks. That is not the report card. The report card is what are you journaling and keeping in reference to for conceptual ideas that you're employing that you're not deviating from. You're sticking to a model. That's the report card. Are you sticking to your model? Do you have a model? And a lot of these jokers out there that talk all that smack on social media because they want to seem cool. They want to seem like they're dialed in. They're locked in. They're just trying to get you hyped up so that way you follow them and get engagement. I'm trying to talk to you with the smallest of degree of leverage. And I'm trying to show you that you don't need a lot. Did you make $3,000 in the last 2 weeks at your job? Did you do that with a total of less than 1 hour's time invested? Chances are you probably didn't. And my 21-year-old has done that. He feels that in his own hands. He's done that. Okay. Now, is he getting help from dad with coaching like today? Sure. Who's going to say anything bad about that? But he's pushing the button. He's moving his stop loss. He's fluttering around trying to figure out when he should move it. He's learning. He's developing. So give yourself that freedom to be able to do that as well. So I mean, I'm going too far on like it's a X space, right? No, no, no. Keep going. Keep going. I got to be under an hour. So it failed to make a close with the body above consequent encroachment. It failed to touch the consequent encroachment there. So we have a lower high. So now we would anticipate what? More protractions to the downside. We have sell side now that was engineered here. And then we have last Friday's regular trading hours opening range gap high, last Thursday's regular trading hours opening range gap low, Tuesday's regular trading hours opening range gap high. Look how it used it right there. Went below it, came out, hit it perfectly. What's that price right here? 24,799 half. What's this candle? You're going to look at this price right here, upper left. What's that candlestick's high? To the tick, baby. Oh, they don't use this stuff. Once the gap's closed, we all know about those gaps, ICT. Come on, you're not teaching anything. You didn't invent the gap, guy. I'm the only one that's telling you how to use it with technical science. So it hits it here perfectly. Bang, hammers it. What time, baby? You waking up now? You falling asleep? What time did it hit that? During a macro time. Ooh, they don't exist, right? So it trades down into some old random levels, but it leaves Tuesday's regular trading hours opening range gap low. It leaves that intact. And then we pull off of that, come back down, touch Friday's regular trading hours opening range gap low. So do you see what I got here? I have a couple days worth, a week's worth of the opening range gap levels. That's the stuff I have with new day opening gaps and the consequent encroachment levels of them, if they're wide, and new week opening gaps and their gradient levels. That's all I have. And maybe once in a while I'll have a previous day's high or low if it's really significant to me. Then I grab it from the daily chart. And I just simply scribble down, what I think is going to be the draw right now for this hour and for the next hour and for the next hour. And then I keep record of how correct I am. And it tells me if I'm on side or not, if I'm in sync with the marketplace. And it's a good little drill for yourself to practice doing that each day. Not even demo trading. Don't even press a button. Just follow price action and have a expectation that you're developing Predictable characteristics of trading. And anybody says your job is not to predict price, you need to stop listening to that person immediately because we're not reacting. Okay. We're not. You are anticipating. A predator anticipates when the prey gets in striking distance, it needs to eat. A lion is not, well, let me react. If something just walks in front of me, there's a little meme that is on social media where this little warthog just runs right by these lions. They're all just chilling. They're in the shade. And this little warthog runs by, blah, 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 and they're like, "What is that?" Not one of them got up and chased it. Why? Because they weren't anticipating it. They're not hunting. So that guy, well, it just walked right on by, no problem. But if they were hunting and that thing got in close proximity to them, it would have been bacon. Goodbye. See you later, pork chops. So, as a trader, we're anticipating, we're looking for it. We want to see the gazelle get down by the watering hole and then it start to run. And we want to see if it's a pack of them, which one's the slowest one because we want low hanging fruit. We don't want to work too hard to eat. So that's what we're looking for. What does that mean? The closest target that makes sense. So if my targets are 37 and a half handles, what did he do today? He used that model with 2 micros because he had enough money to do so. You see how everything fits together? It's using a model, not throwing something in the wind and coming back and saying, "Here's my win for today, and here, 12 laptops." It's nonsense, right? So the market pulls off of that, again, comes right back down, hits the 24,677 level, trades back up to Tuesday's regular trading hours, opening range gap high, gravitates around that, then uses Tuesday's regular trading hours, opening range gap high, again, hits that, sells off, and in between these levels is no man's land. So any PD array that's not laying on top of one of these levels, I'm not really jacked about. Like I could care too less. I don't care less about it really. There has to be a key level for the PD array to be salient to me. Just simply because there's an order block that you think is an up close candle or down close candle. I see so many live streamers, so many educators, so many people out there that are so hopped up on wanting to be cool looking or informed. They look at every single candlestick and they call them incorrectly. And to me, I could be a jerk. I mean, I could go in all your comment sections and sound pompous and arrogant and look like I'm mean spirited. But I don't want to do that because it just looks like I'm trying to get your followers. I don't care about your followers because ultimately they're my followers. Okay, they're learning stuff that I authored, and you're just playing substitute teacher. So you'll learn if you've been doing it long enough or do it long enough. You'll learn that what you're doing is wrong. Okay, and I'm teaching like this. I'm teaching how to find the right PD arrays. There has to be a key level at the right time. Key level, time, your PD arrays will work all the time. All the time, 100% strike right, boom, there it is. Okay. So stop asking me why I'm choosing PD arrays like this and that. Why am I using that fair value gap? Because it's right over top of a gradient level at the right time in deference to where I think the market's going to draw. If you have those 3 ingredients, you're going to have blue ribbon recipe results. It's going to come out beautiful, piping hot and fresh. So the market comes and meanders around in here, rallies up once more, uses Friday's regular trading hours opening range gap low, propels it once more. Look at that immediate rebalance. I love that. As soon as that candlestick opened up like that and it traded down, hammered that like that is one of the easiest. Get in there and go and just reach for some measure of premium. Or if it's simply a small range like 20 handles, 15 handles, 30 handles, you don't even need a liquidity pool for that. Just that's your cookie cutter. If I can get 20 handles of that, boom, done. Rip and run. And there's where we're at here. So this is all simply this meandering around between 2 key levels. So even if you saw like this little thing here, like would you consider that a fair value gap to trade? No. Why? There's no level there. Just simply because there's a separation between 3 candles and one in the middle has an imbalance or what would be conceived as a, or not conceived, but perceived as a imbalance doesn't mean anything to me. It's just a common gap. But it's an extraordinarily important gap if it's laying over top of a gradient level, if it's laying over top of a opening range level. Okay, so notice that we're using very specific price levels. They're not willy-nilly levels. They're not gonna hide these from you. They're not changing the level. It's this is what everybody would see. If you do what I'm teaching here, you're all gonna have the same exact to the tick price level. That's why futures is a gentleman's market, not Forex, because everybody's gonna have a slightly different tick price because you're trading in their liquidity pool. But if you wanna trade professionally and you wanna really use money, big money, and you want precision, you're gonna trade a futures market. You're gonna do that. You're gonna evolve and mature into trading a futures market because that's where the professionals trade. So we talked about SMT, when it's useful and all that business, and what I would have done differently. Going back now, real quick, and then I'm gonna give you my short opinions on dollar index, euro, and pound, and then I'll end this stream, and then we'll hang out together with Kit's uh, trader roundup. So we have this inefficiency here. What time of day is that? It's at 9:40. So that's your very, very first presented fair value gap during the opening range, first 30 minutes. Technically, it's 29 because you want to use minute 31, as I teach my son Caleb. And the reason why, because there's very specific things that you want to use the 9:30 candle if it creates a fair value gap. I don't want to talk too much about it because there's so many things that could go wrong in the hands of someone that doesn't fully know what they're doing. So the rules are better served by following 9:31 to 10 o'clock in the morning Eastern time. The very first presented fair value gap that shows displacement, I think everybody would agree that this is displacement. This candlestick's low right there. That's the high of the fair value gap. And this candlestick's open comes in at 92, I'm sorry, 24,928 quarter. And the close here comes in at 928 3/4. So it's a half a handle or 2 ticks lower on the open on this. So that's the volume imbalance right there. So if I show it to you like this, you'll see. See the separation? See it right there? This candlestick's closed, this candlestick's open. So that's a small little volume imbalance. So that's why I draw it down to that. Okay. And that'll give you more specific price levels. So that way you can know more than Einstein. So trading up into this here, you can be a short seller as it hits consequent encroachment, and your stop loss would be one tick above this candlestick's low. If it stops you out, wait for it to trade back below consequent encroachment. Any run back up, that's a fair value gap or trades into this up close candle here, that would be rejection block. You could be short there. So you could have used that. So in other words, say you went short here using first position fair value gap and went up here and stopped you out. No problem. No problem. You're not going to win every one of them. As soon as it went down below, like it does here, that price right there, you would use that as your entry. That's your rejection block because it should not trade above this here and go above consequent encroachment if it is in fact weak. And there you go. You'd have an example here. Look at this wick. See that wick right there? What is it trading up to? Can you tell I missed you? Can you tell I missed talking to you? Here's consequent encroachment, 24,938 half. Doesn't even touch it 2 times. And then the candlestick goes down below the opening price there. What's the next candle going to do? Protraction. It's going to run. It opens, small little Judas swing, dumps. Where does it go to? Sell side. This is high frequency trading right there. That kind of stuff. Just like this is here. Change in state delivery, hits it, runs down. This candlestick trades below here, outside the body, the opening. So now markets has shifted, internals are shifted, bearish. Consequent encroachment of this wick here. Anything short above this candlestick's close with a stop just above consequent encroachment there is a nice sell, a short. Low hanging fruit, low hanging fruit, and then the actual levels at Thursday, regular trading hours, opening range gap low. I want you to have these levels on your chart. Okay. Sometime this evening, sometime before tomorrow's trading, go back through price action and look at how many times price gives you very, very sweet little price runs that are just cookie cutters. They're just nice little runs. But the main thing is look at how the protraction of the candlesticks and the magnitude of the move is on the down close candles. All of these little retracements, okay, how long are they in duration candle wise? One, two, three, couple of them, right? But when you start seeing the length and degree of how much price moves down, the bigger candles are on the downside. There's more candles going down than there are up. So order flow is what? Bearish. So you're blending two different things here. Where it is respecting and negating going in the upper half if it's bearish, or not if you're bullish, if it doesn't go down the lower half of the discount end of a PD, right? Inefficiency or an order block, something to that effect. We're looking at that characteristic of price action. And you see that with open, high, low, and close. It's a very simple procedure. So here's 6 o'clock opening. Run back into Tuesday's regular trading hours, opening range gap high. Look how smooth that is. So the initial run around in here for, the first 30 minutes or so, it might be just squirrely and just, work around where there's nothing to do. All right, so quickly, let's go over to daily chart again, and we'll look at dollar index. I'm probably over time. I'm sorry if I did.